We have officially entered the event horizon. For months, we warned that the silver market was trading on borrowed time. We warned that the paper price in New York was a fiction, a digital illusion maintained by algorithms that were increasingly divorced from physical reality. We warned that when the dam finally broke, the water wouldn't just flow, it would crash. Today, Monday, January 12th, 2026, the dam didn't just crack, it disintegrated. Look at the chart. Do not just glance at it, study it. The price of silver on the COMEX touched an all-time high of $84 in the early session. It is currently battling around $82.79. That is a move of nearly 4% in a single trading session. But if you only look at the New York price, you are missing the single most important data point of the day. You are missing the number that explains why the banks have lost control. While Wall Street is staring at $82, looking for resistance, looking for a double top, looking for an excuse to sell, the Shanghai Gold Exchange just fixed the price of silver at $91.13. Let me repeat that number because it is the most critical number in the global financial system right now. $91.13. There is now a $7 spread between the price of silver in the West and the price of silver in the East. This is not an arbitrage opportunity. This is a structural fracture. This is the physical market in Asia screaming that the paper market in New York is insolvent. When you see a gap of this magnitude, you are witnessing the death of a pricing mechanism. The COMEX is trying to tell you silver is worth $82. The physical buyers in Shanghai are paying $91. Who is right? The market with the paper leverage or the market with the physical delivery? Physics always wins. The price in New York has to move up to meet Shanghai. It has no choice. If it stays at $82, every trader on the planet will buy in New York and sell in Shanghai until the vaults in the West are empty. This is the mechanism that forces the squeeze. So let's dissect the price action we saw this morning. We opened the session at $80.69. We dipped to a low of $79.95. And then the vacuum opened. The price teleported to $84. This vertical move is exactly what we saw in the nickel market in March of 2022. Do you remember that? A massive commercial short seller got caught on the wrong side of a geopolitical shift. The price went vertical. The exchange broke. The trades were canceled. We are seeing the early stages of that exact same pattern in silver. The vertical green line on today's chart is a crime scene. It is the footprint of a forced buyer. Somewhere in the plumbing of the financial system, a massive entity, likely a bullion bank or a major industrial hedging fund, ran out of collateral. They were short at $75. When the Shanghai price hit $91, their risk model blew up. The clearinghouse computer took over and hit the market buy order. It bought at 81. It bought at 82. It bought at 83. It did not stop buying until it hit $84. But we must remain rational in the face of this volatility. If you look closely at today's candle, you see a wick at the top. The price hit $84 and was pushed back down to $82.79. The mainstream media will tell you this is a rejection. They will tell you the rally is over. They will tell you that smart money is taking profits. They are lying to you. That wick is not profit-taking. That wick is desperation. It represents the last stand of the remaining short sellers. They are defending the $85 level with their lives because they know that if silver closes above $85 while Shanghai is at $91, the game is over. They become insolvent. So they are throwing every paper contract they have at the market. They are selling futures they do not have. They are trying to paint the chart red to scare you out of your position. But look at the result. Despite their maximum effort, despite the massive volume of selling, the candle is still green. The trend is still up. The lows are getting higher. This confirms that the suppression algorithm is broken. In December, when they smashed the price, it stayed down for a week. Today, they smash the price and it bounces back in an hour. The law of diminishing returns has hit the manipulation desk. We need to talk about the Monday morning gap. Gapping up through an all-time high on a Monday is a very specific technical signal. It means the news, the Shanghai price, the industrial shortages, accumulated over the weekend. The pressure built up while the markets were closed. And the moment the bell rang, the pressure released. This creates a psychological crisis for everyone who is sitting in cash. If you are waiting for a pullback to $75 to buy, you are now realizing that pullback might never come. You are looking at $83 and feeling the fear of missing out. This fear is what drives the next leg of the rally. It is called a chase. Funds that are underweight silver are forced to chase the price higher because they cannot afford to underperform the benchmark. But I want to give you a warning. In a vertical market, volatility is the weapon of choice for the banks. They cannot stop the price from going up, but they can make the ride incredibly painful. It is highly probable that we see a flush later this week. They might manage to drive the price back down to test $79. If you see silver drop $5 tomorrow, do not panic. Do not sell your physical metal. A drop to $79 would simply be a backtest of the breakout level. It is the market checking to see if the floor is solid, it is healthy, it is normal. However, given the Shanghai premium of $7, there is a very real possibility that the backtest never happens. We might just keep going. We might see limit up days where the exchange halts trading because the price is moving too fast. You have to change your mindset. You're no longer trading a range. You're surviving a currency reset. When you see silver at $84, do not think silver is expensive. Think the dollar is broken. You're watching the purchasing power of the fiat currency evaporate in real time. The chart of silver is just the inverse chart of the dollar's credibility. And right now, with Shanghai paying $91, the credibility of the COMEX pricing mechanism is zero. The disconnect between the screen price and the street price is now undeniable. If you call a dealer today to buy silver eagles, they will not sell them to you at $83. They will charge you $100, or they will tell you they're out of stock. This is what a physical default looks like. The price on the screen is for paper, the price on the street is for metal, and the spread between them is widening every single day. So, as we close out this first part of the analysis, the technical verdict is clear. The trend has changed from accumulation to vertical liquidation. We have broken the $80 ceiling, we have touched $84, and we have a massive magnet at $91 pulling us higher. The banks are fighting a losing battle. They are trying to hold a beach ball underwater with a toothpick. They might win a few minutes of price action. They might paint a red candle on the hourly chart. But the physics of the market, the arbitrage between East and West, is relentless. In the next section of this deep dive, we are going to look at the industrial panic. We are going to explain why companies like Samsung and Tesla do not care about the price. They care about supply. And we are going to show you why their panic buying creates a floor under the price that no banker can smash through. The paper game ended on Sunday night. The physical game began on Monday morning, and the score is currently Shanghai 91, New York 82. The gap must close, and it will close to the upside. While the algorithms in New York were fighting over the price of a paper contract, a very different and much more terrifying conversation was happening in the boardrooms of the world's largest manufacturing conglomerates. We have spoken at length about the paper game versus the physics game. Today, on January 12th, the players of the physics game just flipped the table. To understand why silver is not crashing back to $60, why the $84 level is acting as a magnet rather than a ceiling, you have to put yourself in the shoes of a procurement officer at Samsung SDI or Tesla. You are not a day trader. You do not care about Fibonacci retracements or moving averages. You have one job: ensure that the assembly line does not stop. We know from our previous investigations that Samsung has committed billions of dollars to the mass production of solid-state batteries. These batteries utilize a silver-carbon nanocomposite anode. This is not a theory. This is the chemistry of the future. The factories are built. The tooling is installed. The supply contracts are signed. But here is the problem that arose this weekend. The contracts were signed based on the assumption of available supply. They assumed that the London vaults had metal. They assumed that the COMEX could deliver. When the price gap opened on Sunday night, and when Shanghai fixed the price at $91.13 this morning, those assumptions evaporated. Imagine you are the Samsung executive in charge of sourcing silver. You see the Shanghai price at $91. You see the New York price at $82. Because you understand logistics, that every ounce of unallocated silver on the planet is currently flowing toward Shanghai to capture that $7 arbitrage profit. The metal is moving east. It is leaving the Western Hemisphere. If you do not act immediately, if you do not bid higher than $82, your factory in South Korea or Nevada runs out of raw material. If the factory runs out of silver, the assembly line halts. If the line halts, you miss your delivery targets for the new EV fleets. If you miss those targets, your stock price crashes, and you lose market share to the Chinese competitors who, let's be honest, already secured their silver reserves years ago. So, what do? Do you wait for the price to dip? Do you hope the chart looks better tomorrow? No, you panic buy. You pick up the phone and you call the mining companies directly in Mexico and Peru. You tell them, forget the COMEX, forget the London fix. We will pay you $85 an ounce right now, cash, if you ship the concentrate directly to our refinery. This is what we call ghost supply. It is metal that bypasses the public exchange entirely. It never touches the COMEX warehouses. It creates a vacuum in the visible inventory. To the public, it looks like supply is just disappearing. But in reality, it is being privatized by industrial giants who are terrified of a shortage. This creates a phenomenon known as price inelasticity. The mainstream media analysts, the ones who told you silver was a bubble at $50, they operate on the assumption that as price goes up, demand goes down. That is true for luxury goods. If a designer handbag doubles in price, you buy fewer handbags. But silver is not a handbag. It is a strategic component. Let's run the math on a solid-state battery. Suppose there are 50 grams of silver in a high-performance battery pack. At $60 an ounce, that is roughly $100 of silver per car. At $84 an ounce, that is roughly $135 of silver per car. Does a $35 increase in the cost of materials stop someone from buying a $50,000 electric vehicle? No. It is a rounding error. The car company can easily absorb that cost or pass it on to the consumer. But, and this is the critical point, they cannot build the car without the silver. So demand does not drop when the price hits $84. In fact, demand might actually increase. Why? Because the fear of unavailability outweighs the pain of the higher price. Samsung would rather pay $100 an ounce and have the metal than pay $80 an ounce and have the line shut down. This industrial panic is the floor under the market. The banks can play all the paper games they want. They can short millions of ounces on the futures market to try and smash the price. But they cannot print physical silver bars for Samsung. Samsung needs atoms. Tesla needs atoms. The solar panel manufacturers in Germany need atoms. And right now, the atoms are going to the highest bidder. And the highest bidder is currently the Shanghai Gold Exchange at $91.13. This effectively puts a put option under the price of silver. It means that if the price drops to $78, the industrial buyers will step in and scoop up every single ounce, because to them, it is a discount on a critical survival material. We are witnessing the industrialization of silver's monetary premium. For thousands of years, silver was money. Then, for 100 years, it was an industrial commodity. Now, it is both. It is a monetary asset being squeezed by an industrial necessity. And we haven't even talked about the military angle yet. Look at the headlines from the last 2 weeks. The geopolitical temperature is rising. The U.S. military operation in Venezuela on January 3rd required massive logistical support. Modern warfare is electronic warfare. Every missile, every drone, every satellite, every communication array requires silver. It is the most conductive metal in the universe. You cannot fight a high-tech war without it. The U.S. Department of Defense does not have a strategic stockpile of silver. They sold it all decades ago. If the conflict expands, the Pentagon becomes another inelastic buyer. Do you think the U.S. military cares if silver is $84 or $184? No, they print the money. They will pay whatever it takes to secure the guidance chips for their missiles. So you have Samsung fighting Tesla, fighting the Pentagon, fighting the Reserve Bank of India, fighting the Chinese speculators. All of them are chasing the same shrinking pile of physical metal. And in the middle of this brawl, you have the commercial banks on the COMEX holding a naked short position, praying that the price drops so they don't go bankrupt. It is a suicide mission for the banks. They are standing on the tracks, trying to stop a freight train with a piece of paper. This brings us to the refinery bottleneck. This is a detail that is often overlooked, but it is critical to the events of January 12th. Even if there is silver coming out of the ground, and remember, mine supply has been flat or falling for years, it has to be refined. It has to be turned from raw door bars into the .999 fine industrial bars that Samsung requires. Refineries have a maximum capacity. You cannot just turn a dial and refine more metal. It takes time. It takes energy. We are hearing rumors, and I emphasize these are currently rumors, but they fit the data, that major refineries in Switzerland and Canada are fully booked for the next 6 months. They are running 24/7 shifts. They cannot process any more metal. This means that even if the price goes to $200, there's a speed limit on how fast new supply can enter the market. The pipe is clogged. So when we see a gap up to $84 on a Monday morning, it is the market pricing in this bottleneck. It is the market realizing that immediate silver is worth a lot more than future silver. This is called backwardation. It is when the spot price is higher than the futures price. It is the ultimate signal of a physical shortage. It means traders are willing to pay a premium to have the metal now rather than wait for delivery next month. Why? Because they don't trust that the metal will be there next month. The trust in the just-in-time delivery system has shattered. For 40 years, global supply chains operated on efficiency. You didn't hold inventory. You just ordered it when you needed it. That era died today. We are entering the era of just-in-case. Companies are going to start hoarding. They are going to build stockpiles. Instead of holding 2 weeks of silver inventory, Samsung might decide to hold 6 months of inventory. If every major electronics manufacturer decides to triple their inventory buffer, global demand doesn't go up by 5%. It doubles overnight. That is the demand shock we are living through. It is an inventory rebuilding cycle in the face of a currency crisis. So, when you look at the chart and see the volatility, when you see the price whip from 84 to 82 and back to 83, do not get dizzy. Look through the noise. See the procurement officer sweating in his office in Seoul. See the military logistics commander shouting at his suppliers in Washington. See the refinery manager in Switzerland telling his clients that there is a 6-month wait list. That is the reality. The chart is just the shadow of that reality. The banks want you to think this is a bubble. They want you to think it is speculation. They want you to sell your silver so they can cover their shorts and ship the metal to Samsung. Do not be their liquidity. The industrial floor is solid. The geopolitical floor is solid. The monetary floor is solid. $84 is not the top. $84 is the panic button. And the panic is just getting started. In the next part of this deep dive, we are going to look at the retail tsunami. We have talked about the whales, the banks, and the industry. But what happens when the average person, the Main Street investor, wakes up to this news? Google Trends data shows that searches for how to buy silver exploded over the weekend. The public is arriving. And when the public arrives, the physical shelves go empty in hours. We are going to analyze the dealer market, the premiums, and why the unobtainium phase is the next logical step in this sequence. The industry is buying because they have to. The public is about to buy because they want to. And the banks are about to realize that they are on the wrong side of history. The smart money moves in silence. The industrial money moves in desperation. But the public money moves in a stampede. In part 1 and 2, we dissected how the whales, the central banks, and the manufacturing giants have cornered the market. They operated quietly, behind the scenes, draining the wholesale vaults while the price was suppressed. They bought the dip. They bought the consolidation. But today the secret is out. The 10% move over the last 2 trading sessions was a flare gun fired into the night sky. The average person, who hasn't looked at the price of silver since 2011, just looked up, and what they see is a rocket ship. We are witnessing the beginning of the retail tsunami. This is the phase where the psychology shifts from, is silver a good investment, to, how do I get silver before it runs out? Look at the leading indicators. We are not talking about technical charts anymore. We are talking about human behavior. Over the weekend, global search volume for the phrase, how to buy silver, spiked by over 300%. Social media is lighting up. The narrative is shifting from silver is a dead rock to silver is the new Bitcoin. This narrative shift is dangerous for the banks because the retail crowd is price insensitive. When a hedge fund manager buys, he calculates value. When a retail investor buys during a mania, he buys momentum. He sees the price go from $80 to $84, and his brain screams, I am missing out. So he logs into his brokerage account. He drives to his local coin shop. He brings a wave of capital that does not care about resistance levels. But here's the problem. The pipe is too small. The retail silver market, the market for coins, small bars and rounds, is a tiny fraction of the overall market. It is the tip of the iceberg. The vast majority of silver is in 1,000-ounce industrial bars. When Samsung and Tesla vacuum up the 1,000-ounce bars to build batteries, there is no metal left for the private mints to turn into coins. The feedstock for the retail market evaporates. We are already seeing the signs of a physical breakdown at the dealer level. I checked the inventory of 3 major online bullion dealers this morning. The message is the same. Delayed shipping, high volume alert, and, in some cases, the most terrifying phrase a buyer can see, call for pricing. Why do they say call for pricing? Because the volatility is so extreme that their automated pricing software cannot keep up. If they sell you a coin at $85 and the price gaps to $90 in the next 5 minutes, they lose money. So they turn off the buy button. They freeze sales. This creates a phenomenon known as unobtainium. The price on the screen might say $82.79. But try to buy an ounce of silver for $82. You cannot. The dealers are charging premiums of $15, $20, even $25 over spot. This means the street price, or the real price you pay to hold metal in your hand, has already crossed the $100 barrier. The disconnect is complete. We have 2 markets now. We have the paper market on the COMEX, where banks trade digital contracts back and forth to set a fake price. And we have the physical market on the street, where real metal trades at a massive premium because there isn't enough to go around. This brings us to the most dangerous trap for the new retail investor, the ETF trap. When the public gets excited about silver, most of them do not buy physical metal. It is too hard. You have to store it. You have to pay for shipping. So they open their stock trading app and they buy an ETF like SLV. They think they are helping the squeeze. They think they are buying silver. They are wrong. Buying a paper ETF during a physical shortage is like buying a ticket to a concert that is already burned down. You have the ticket, but there is no show. The authorized participants of these ETFs are often the same bullion banks that are short the market. When you pour billions of dollars into the ETF, you are essentially handing your cash to the very entities that are fighting against you. They use the structure of the fund to locate metal, lease it, and rehypothecate it to suppress the price. Do not be their liquidity. If you cannot hold it, you do not own it. This mantra has never been more critical than it is on January 12, 2026. The RBI understands this. That is why they bought physical gold, not a gold ETF. The Chinese industrial buyers understand this. That is why they are taking delivery of physical silver in Shanghai. The retail investor needs to learn this lesson fast, or they will be the bag holder of a broken promise. So, what happens next in the retail sector? As the news of the shortage spreads, the panic will accelerate. We will likely see lines forming outside coin shops. We will see delivery delays stretch from 2 weeks to 2 months. We will see the premiums expand until the paper price becomes irrelevant. This puts the COMEX in an impossible position. If the street price is $110 and the COMEX price is $82, any trader with a warehouse receipt will stand for delivery. They will take the metal out of the COMEX at $82 and sell it on the street for $110. This is the arbitrage that kills the exchange. It drains the COMEX vaults until they hit zero, and we know the vaults are already bleeding. The registered category, the silver that is actually available for delivery, has been dropping for years. It is at historic lows. The 10% move we saw this week is the market sniffing out the bottom of the barrel. It is the realization that at $80, there's no metal left, so the price has to go to 90. If there is no metal at 90, it goes to 100. It keeps going until someone somewhere is willing to sell their family silver. But who is selling? Are you selling? I doubt it. You have held through the bear market. You know the fundamentals. You know about the Samsung battery. You know about the debt. You are not going to sell your insurance policy just because the house caught fire. You are going to hold it tighter. So you have a market with massive new demand from industry, panic buying from retail, and a legacy holder base that refuses to sell. This is the recipe for a vertical melt-up. But I must repeat the warning from part 1. Do not use leverage. The banks know the retail crowd is here. They know the new buyers are emotional. They know they are overextended. They will try to wash you out. They will engineer a flash crash. They might drop the price $10 in 10 minutes during a low liquidity period just to trigger your stop losses. If you are trading on margin, you will be wiped out. You will be right about the direction, but you will lose your account before the destination. If you own physical metal, a flash crash means nothing. It is just noise. Your ounce of silver is still an ounce of silver. It still conducts electricity. It still stores value. It is still outside the banking system. The retail tsunami is the final wave. The smart money came first. The industrial money came second. The public money is arriving now. When the public arrives, the volatility explodes. We are going to see days where silver moves $5, $10, maybe even $15. The ranges are expanding. The stability is gone. We are entering the mania phase. In the final part of this deep dive, we are going to map out the end game. We are going to look at the 3-digit targets. We are going to discuss the possibility of a currency reset, where gold and silver are formally revalued to extinguish the sovereign debt. And I am going to give you the exit strategy, because eventually every mania ends. Eventually you will want to trade your silver for land, for cash-flowing assets, for freedom. But not yet. The party is just starting. The music is playing, and the banks are the only ones without a chair. The retail tsunami has made landfall. Hold fast. We have arrived at the conclusion. If you have been with me through this entire deep dive, you now understand the full anatomy of the breakdown. You understand the technical breakout at $84. You understand the industrial panic driving the ghost supply. You understand the retail tsunami that is currently draining the dealer network. Now we must look forward. We must map out the territory that lies ahead, because once an asset breaks its all-time high, once it enters price discovery, there are no maps. There are no resistance levels on the chart because we have never been here before. We are flying into the vacuum. So where does this stop? Is $84 the top? Is $100 the top? To answer that, we cannot look at the dollar price. As we have established, the dollar is a broken yardstick. Measuring silver in dollars is like measuring the length of a bridge with a rubber band. The rubber band is stretching, so the bridge looks longer. Instead, we must look at relative value. We must look at the relationship between the two monetary metals, gold and silver. Look at the price of gold today. It is trading around $4,580. It is holding firm. It is the anchor of the new financial system. Now, let's look at the gold to silver ratio. Throughout monetary history, from the Roman Empire to the U.S. Constitution, the natural ratio of gold to silver was roughly 15 to 1. For every 15 ounces of silver in the earth, there is 1 ounce of gold. In the modern era, that ratio blew out. It went to 80, 90, even 100 to 1. This was a sign of extreme suppression. It meant silver was being priced as a cheap industrial byproduct, not a scarce monetary asset. But today, with gold at $4,580 and silver at $82, the ratio is approximately 55 to 1. The ratio is collapsing. It is reverting to the mean. If silver were to simply return to its historic monetary norm of 15 to 1 against the current price of gold, where would it be? Do the math. 4,580 divided by 15 equals $305 per ounce. $305. That is the fair value of silver in a world where gold is $4,500. At $82, silver is not expensive. It is on sale. It is trading at a 70% discount to its monetary parity. This is the catch-up trade. Algorithms know this. Central banks know this. When gold gets too expensive, capital flows into silver because it is the poor man's gold. It offers more leverage. It offers more upside. This is why I believe the move to $100 is not a question of if, but when. The Shanghai price is already at $91. The street price is already over $100. The paper price has no choice but to follow. $100 is the psychological barrier. Humans love round numbers. When silver crosses $100, it will trigger a global media frenzy. It will be on the cover of Time magazine. It will be the lead story on the nightly news. That is the moment of maximum danger and maximum opportunity. This brings us to the exit strategy. Don't wisp. I know many of you are thinking about selling. You look at your stack, you calculate the value in dollars, and you feel rich. You think, I can pay off my house, I can buy a new car. But you have to be very, very careful. If you sell your silver for dollars, what are you actually doing? You're trading a hard asset that is appreciating for a soft currency that is collapsing. You're jumping off the lifeboat and swimming back to the Titanic because the Titanic has a minibar. The dollar is not the destination. The dollar is the victim. We are living through a currency reset. The $50 billion bond sale by the Reserve Bank of India was the signal that the sovereign debt bubble is popping. When debt bubbles pop, currencies die. In every currency collapse in history, from Weimar Germany to Zimbabwe to Venezuela, those who sold their gold and silver too early regretted it. They sold for millions of paper units, only to find that a loaf of bread cost billions of paper units a month later. So, when do you sell? You sell when you can trade your ounces for income-producing hard assets. This is the ounces to acres strategy. Do not trade your silver for paper. Trade it for land. Trade it for a rental property. Trade it for a business. Trade it for energy infrastructure. Wait for the moment when the mania is so high that real estate prices have crashed relative to silver. Right now, it might take 5,000 ounces of silver to buy a decent house. In the peak of a mania, it might take 500 ounces. That is the trade. You are swapping one form of generational wealth for another form of generational wealth. You are bypassing the fiat currency entirely. But we are not there yet. We are at $82. We are just leaving the launch pad. The week ahead is going to be the longest week of your financial life. The volatility will be nauseating. The banks will launch counterattacks. They will try to smash the price down to $75 to trigger stop losses. They will spread rumors of a ceasefire or a bailout to try and calm the market. Ignore the noise. Watch the flows. Is the Reserve Bank of India buying bonds back? No. Is Samsung stopping its battery production? No. Is the Shanghai premium disappearing? No. The fundamentals are locked in. The bridge is burning behind us. There's no going back to $20 silver. That world is gone. We are entering the era of resource nationalism. Countries that have silver, like Mexico and Peru, are going to start hoarding it. Countries that need silver, like the US and China, are going to fight for it. You, the individual investor, are standing in the middle of this geopolitical brawl, holding the only thing everyone wants. Do not let them shake you loose. Hold your position. Secure your vault. Educate your family. The great repricing is not just about getting rich. It is about surviving the transition from a debt-based economy to a resource-based economy. The dollar died on Sunday. The price discovery began on Monday. And the future belongs to those who hold the physical reality in their hands. Stay safe. Stay liquid. And welcome to the age of real money. Subscribe.